Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to investing, the markets, real estate, and basically everything as it relates to personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But in today's video, I wanted to talk about the sort of moral dilemma that has been presented by all of these new people pouring money into the stock market who maybe have never invested in the past, but have access to stock investing with very little money. It can even get access to higher risk products, as I'll definitely get into in this video. But this was prompted by an article I read in the Washington Post that was talking about fractional shares and how they've basically been an outlet of sorts for people who might otherwise gamble on sports betting. It mentions that a couple times in the article that sports betting isn't a thing right now because there are basically no sports, and that people want an outlet to gamble and they can get into stocks really cheaply with fractional shares and can start playing with stocks that way. Because a lot of different brokerages offer fractional shares. And for those of you who don't know what a fractional share is, it's where rather than having to buy a full share of a company, you can just buy a small portion of a share, and that's your position in the company. So basically, the share price itself, at least the barrier to entry, is practically eliminated. You can get into a stock with just a few dollars and you get a fraction of a total share. Now, a lot of brokerages offer this. Robinhood has started to roll it out in earnest, where you can actually start with fractional shares. M1 Finance, a brokerage that I pitch on this channel all the time because I think it's awesome, they offer fractional shares, and really it's more fine-tailored towards balancing your portfolio, so that if you want to start a portfolio with 100 different holdings and you only have $1,000 to use, you're not going to have enough to buy a share of Amazon if you want your portfolio to have any Amazon in it, because Amazon shares are a couple of grand. So you can get started with a couple $100 or even less and actually buy these large cap companies which maybe have very high share prices at the same time. And that's great, at least from an accessibility standpoint, in that you can actually get started investing without needing a ton of money, and you can get into those companies that you actually want to invest in without having to worry about forking over $300-something thousand to buy a share of Berkshire Hathaway. Instead, you can buy a fractional share of the Berkshire stock, and that's great. You can get started with investing in whatever stock it is without having to really worry about the specific share price as being too high to actually invest in. Because not everyone starts with many thousands of dollars when they get into stock investing, especially if you're a younger investor. Maybe you've just started your career, maybe you just got some money from a stimulus check and you want to be responsible and you want to invest it somewhere, but you don't have enough money to buy a full share of Amazon if that's what you're choosing to do. You have the ability to do that with fractional shares, and many larger brokerages are starting to offer this feature as well. And I would imagine that sooner rather than later, all brokerages are probably going to offer this in some capacity at some point. But it's a double-edged sword, as this Washington Post article and others have pointed out, and that's that the accessibility that fractional shares allow also comes with a lot of risk for people who don't know what they're doing when it comes to stock investing, or who are taking inordinate amounts of risk with money that they might not be able to afford to lose. You can kind of look at it this way. If you had a few grand saved up to buy a share of Amazon, that probably means you're a better saver than someone who might only have $100 but is itching to get investing. And that's not always the case, of course, but that is probably more likely than not. And if you're able to actually save a few $1,000s before you start investing, you probably are a little more financially savvy than someone else, or at least you're positioning yourself in a less risky way, and you'll at least have a little more flexibility if push comes to shove and things get tough in the economy. Whereas if you're just starting with $100 and that's all you can muster to start investing in stocks, that probably is a red flag that you don't have a lot of disposable income or money to actually cover yourself if something goes bad, and that could be a problem, especially when you get a huge market downturn like we just had. Granted, it recovered very quickly for a variety of reasons, as I've talked at length on in this channel, mainly as they relate to the Federal Reserve. But anyways, there's a big chance that we're going to have another crash at some point. Maybe it's many years from now, maybe it's a couple months from now, but there's probably going to be a crash. And if someone only has $100 to spare, maybe it's best that they put it into something like an emergency fund. Maybe it's best that they use it to pay down some debt that they have. It depends. Everyone's financial situation is different, but it raises some questions as to why you're throwing your $100 on stocks when you probably have more pressing issues or some sort of savings issue, and there might be issues that are causing you to not be able to save much, like high debt and that sort of stuff. But this is all speculative. Not everyone's like that. There are people who just maybe aren't that comfortable with stock investing and want to get started with a low risk $100 position in a otherwise expensive stock, and that's what fractional shares are phenomenal for. They let you get into the stock market with very little money, and you can kind of get a feel for how the market works and what it's like to see your stock value go down, and also how it feels for it to go up, and how you might act if stuff like that happens. It's great to get accustomed to that sort of thing because there are tons of short-term volatility in the market, and being able to get used to that is an important thing. Now, I definitely argue that some investing is better than no investing, and I'm specifically talking about investing. Those who buy stocks for the long term, trying to build a financial foundation for their future, making sure that they're investing with a longer term time horizon to where they can actually be in a better position many years from now because they invested in quality companies or quality assets in general. That's great. And fractional shares allow someone to get going with that quicker, get them motivated to start investing in the stock market, and really fine-tune your portfolio to where you can have a ideal balance based on whatever your preferences are, because you can buy fractional shares of each of those companies without having to sort of throw your portfolio out of whack because you have to buy a full share of a very expensive one. But beyond fractional shares, you also have things like margin debt, which is certainly far more risky than just your typical day trade because you're adding debt to something. Now, in addition to actually buying a stock, which could lose all of its value, you have this debt, which is permanent. That debt is permanent till you pay it off. Whereas if the stock value goes down, that means you've lost your money. You've lost that money and you can't use it to go pay down that debt. So it's very high risk when we're talking about short-term trades, especially leveraged options, since a lot of brokerages, including Robinhood and others, allow you to get started with options trading very quickly. With really no real experience, you can just say whatever your experience is, and then bam, Robinhood gives you 100% of your account value to be able to use a margin loan on, and you can start investing in options as well, which options are a totally much higher risk market compared to typical stock investing. So you're almost giving a loaded gun to somebody, being like, hey, I don't know if you know how to use a gun, but here you go. I mean, I don't know about you, but I'd be a little worried if gun shops were just handing guns out to everybody, because that could cause a lot of problems if you get too many of those people, or if one of those people goes crazy and starts causing a bunch of problems, and then you run the risk of them causing harm to themselves, like significant harm to themselves. We all saw that tragic story about that person who invested in Robinhood using a gigantic margin loan that he somehow had access to, and it showed that he had a negative $700,000 balance at one point, and he actually killed himself because of how upset he was, because he thought his financial life was over. And that's a problem. When people who may not have the temperament or maybe not even the temperament, it's just that they don't even know what they're getting into, and this is what they have access to. They're getting access to something that they have no idea how it works, or they don't know the actual risks associated with that investment. And there's a ton of that that's becoming more accessible as stock investing and options investing and all these other sorts of financial products become more accessible. Now, this is where I run into the dilemma. I realized that you could save a lot of harm by preventing people from investing in things like fractional shares without proving some sort of experience or something like that. But at the same time, who's the judge? Who's going to be the person that says, you can't invest, but this person can? That's very dangerous. We already have that sort of with accredited investors. You and I can't easily invest in something like a private company, or more like it, a private company can't raise money from people randomly on the public market very easily. It usually has to be from accredited investors. And accredited investors, for those of you who don't know, are those who make over $200,000 a year or have $1 million in net worth approximately. That's the general rules that you have. When you're an accredited investor, you can go and buy pretty much whatever you want in the investment world, and there's just a lot less bureaucracy and paperwork associated with it. Now, the idea is to protect investors, and arguably it does, because Now, people who don't understand what they're investing in aren't going to get burned. It tries to prevent a lot of fraud. You'd assume that someone with that kind of income and a larger net worth would be pretty financially savvy and would understand the risks associated with an investment, whereas someone with a $5,000 net worth or even a negative net worth probably doesn't really have as firm a grasp on finances as someone who might have a lot more. Not always the case, but it's just more likely than not. But the problem with that is now you don't have access to a lot of private offerings because they are not allowed to sell those to the public at all. Or if they do, it has to be to people like accredited investors, or they have to make all these obnoxious disclosures, which people probably won't read anyways, and then you cause even more problems because now you're making investing less accessible and you're allowing the rich to get richer and the poor don't have access to this sort of investment. I don't see that as a good thing. It's a trade-off, obviously. You're protecting some at the expense of others. Is that worth it? I don't really know. And that's why I'm making this video, because I just kind of want to put that idea out there first of what that fine balance is and who's actually making that decision when it comes to something like margin investing, fractional shares, and giving access to the stock market to anyone and everyone with no fees and reducing all these barriers to entry. Because on the one hand, it's fantastic that anyone can invest in stocks and can start building their financial future and can start moving towards financial independence or just trying to make their lives better by investing their money rather than spending it frivolously on things. But at the same time, you're giving access to people who just want to gamble and can destroy their lives by making huge bets on short-term trades with lots of debt, and that's terrible. And people might not be ready to handle that sort of thing. And whose job is it to say that, hey, you can't do that? It's hard to say. I hesitate to put that all in the government's hands because you can lead to abuse and maybe the decision's wrong. Who knows what the best decision is? We don't have a ton of data with this, as we're in kind of an unprecedented territory with this market where we have way more people being able to invest and they have very easy access to debt. Well, maybe it's not quite unprecedented. That sounds kind of like the 1920s, where basically anyone could get a margin loan on their stock to buy more stock, and then you cause this sort of bubble. We're in kind of that same sort of territory, and we obviously want to avoid that as an economy. We don't want bubbles. Bubbles are a bad thing, but then again, you want people to be able to actually take advantage of opportunities, since America is the land of opportunity, and hopefully we'd want to keep that opportunity open. Anyways, I kind of went in circles there, but I hope that idea at least is clear, that there is a trade-off here when it comes to making the barriers to entry to investing. Not only does it make things better for those who actually want to invest and understand the risks and are trying to move forward financially from a lower position, that's great. But at the same time, you have people who don't understand the risks, who now still have access to those same products and can really harm themselves with it. If you like this video, definitely like it since it helps the channel out a lot. I put out new videos every single week about investing, whether it be the stock market, also real estate investing. I just got under contract on another property that I will be happy to update you guys on very soon. So definitely subscribe if you want to see those updates and so you don't miss any of my new videos. I'd be happy to see you here every single week. But if you actually want to get started with fractional shares, I have links to both Robinhood and M1 Finance and also Webull down there. You can get some free stocks for signing up for those brokerages. They're all free, by the way, so you might as well take a look. If you're interested in stock investing and you don't have accounts with those brokerages, definitely give them a look. And if you end up signing up for some of them, they are affiliate links, so I might get a bonus if you do it. But definitely check it out, especially getting those free stocks, since it's free stocks. Just take them. You don't even need to trade after that. Just close your account. Just please do that for me and yourself. But I'd definitely love to get your guys' thoughts in the comments below about this sort of dilemma when it comes to allowing access to the markets and these more complicated and more risky financial products. I'd love to hear your thoughts on that, so definitely let me know in the comments below. But until next time, take care.